I want to thank everybody for joining us for this webinar on direct lending. I'm Marty Exline with the AT3 Center, and we're happy to have you here today. There's been definitely an interest by more state AT financial loan programs, state and territory programs, to explore direct lending. And by direct lending, we mean loans that are managed in-house as opposed to being managed by a banking institution or other financial partner. Some state and territory AT programs manage all their loans in-house, while others manage some loans in-house and others through a financial partner. And the programs currently operating in direct loans really do range from those that are processing a relatively smaller number of loans to those who are processing 100 loans a year and more. And so this webinar, we want to kind of explore the activities, the advantages and challenges to providing direct loans. Oklahoma Able Tech is one of the AT programs that has transitioned to managing their loan program in-house. And Shelley Gladden from Able Tech is here to describe that program's journey from to a direct lending program. And then we'll also want to hear from others who operate direct loan programs who have questions as they consider moving from a loan program managed through a banking partner to an in-house direct loan program. And so I'm going to go ahead and turn it over to Shelley. If everyone will just make sure that they're muted, and then once we take questions, then we'll go ahead and allow people to unmute themselves. So with that, I'm going to go ahead and turn it over to you, Shelley.
All right, great. Can you hear me okay?
Yes.
That's always a nice little test. I did also want to remind that if anybody wanted captioning, there should be a place to turn it on your screen. Is that correct?
Yes.
Okay, good deal. Well, hi, everyone. Thanks for having me, Marty, and the AT community of practice peers. I was asked to be with you all today in regards to the transition Oklahoma Able Tech went through to become direct lenders for financial loan programs. So we'll just kind of dive right into that. If I can get my mouse to work. Hold on, I'm frozen. There we go. Okay, so we're going to walk through the history, the lending transition, and the steps we took to get to direct lending. We're going to touch on how our loan policy and board decisions supported the change and look at some comparative analysis of numbers over the history from banking partner to direct lending, and then where we are today in regards to our loan program. As you know, I'm kind of preaching to the choir, but as you know, the financial loan program is a low interest and or guaranteed bank loan that provides individuals with disabilities or those that have a dependent with a disability the opportunity to borrow money for the purchase of needed assistive technology and or related services. Oklahoma Assistive Technology, or referred to as OCAT, is our nonprofit community-based leg of the triangle. Through contract with Able Tech, received $1.7 million in Title III, telework, and state match funds over a 4-year period to start the financial loan program. I love this number. As of April 30th, 2019, we've done, for the life of the program, we've done 1,303 loans, a total amount of $7,298,966. Average loan amount at $5,601. I love this number. It gives us validity to what we do every day and not just kind of spinning our wheels of this program. We've turned over that $1.7 million that we originally received almost 4.5 times in lending. To me, if anything speaks sustainability, it's that number. We're pretty proud of that. Traditionally, this has been our model in the participating partners since inception of the program. I think it's important to talk about where we are coming from to compare the roadmap of direct lending. So as you can see from 2001, Oklahoma Assistive Technology is the community-based organization that operates the state financing programs utilizing those federal funds. It's made up of 9 volunteers who have a background using assistive technology or serving people with disabilities. Bank First of Stillwater has been our banking partner since the beginning. Participating bank partner that provides the banking responsibilities for guarantee interest buy down and guarantee interest buy down loans. They provide underwriting, monthly reporting, and dedicated staff to serving the program. They provide statewide services for banking partner loans through branch locations. And then, of course, Oklahoma Able Tech, that's us, the State Assisted Technology Act program. We're housed at OSU within the Department of Wellness. And they provide, Able Tech provides a lot of personnel to facilitate the daily management of the program and provide a lot of in-kind services for daily operations, including the marketing, staff support, office supplies, all of that good stuff that goes with it that's usually a cost of operations. Up until a few years ago, this was our lending program that provided bank partner interest buy down or interest buy down with a guarantee loan. So to tell a little bit about how this model worked for us, and I'll just kind of go through this pretty quickly. Our banking partner starts the process for our guarantee and non-guarantee loans. If approved with the bank's standard consumer loan criteria, the loan is closed by the bank with an interest buy down to 5% paid by the program. If it's denied by the bank, then the application is sent to OCAT for a guarantee consideration. And then OCAT policy for loan approval is a little more forgiving and flexible than the banking partner. The board, by policy, reviews the following criteria for loan decision and approval: a minimum credit score of 500. If there are any derogatory accounts on the credit report, what it is about, how has it been resolved or an action plan in place. If it's related to medical, we'll overlook that in the decision process, as well as bankruptcies are typically overlooked too. The board also looks at consumer income to debt ratio, not more than 50% of income going out to obligated debt, such as other loans, mortgage, rent, credit cards, etc. There's a little circumstantial flexibility in this model with supporting information and documentation. If they have some things in place, being able to get some of those credit issues resolved, then the board will consider that. And then the general ability to make the monthly payment. The last two mentioned are put into a monthly expense sheet to review cash left over to support the monthly payment. And again, circumstantial considerations are reviewed, explanations of adverse credit, how they are being resolved. Were they within 6 months or greater than 6 months of negligent payments or something like that. And then policy drives a decision to be made by the board within 5 business days. So we try to have a pretty quick board-driven policy of that turnaround time. If it's approved by OCAT for a guarantee loan, then of course the bank closes on the loan, OCAT signs as a guarantee, OCAT buys down the interest rate to a 5% for the consumer. If it's denied, any loan denied receives coaching on becoming quote-unquote loan ready. This can include allowing them time to repair credit issues, negotiate monthly payments with the creditor, save funds for a down payment, seek co-applicants, and then opportunity to reapply when ready. And then, of course, we're always with that Able Tech leg giving them resources for other programs that they might qualify for. So I think that's pretty traditional for a lot of interest buy down and guarantee programs. Several years ago, we started evaluating what are the pros and cons of this model. And some of those pros are, the bank does the daily management of the loan. It's easy to manage on our end. The bank does the underwriting, closing of the loan, coordinating with consumer, managing those monthly payments or non-payments, and then sends us everything at the end of the month. Bank balances, consumer information, if it's interest buy down only. And we only have to set aside a small percentage for loan loss reserve for guarantee loans and not all loans. Again, it doesn't require a whole lot of manpower or support And we don't have to expend a large amount of capital for loan disbursement. So that's some of those pros related to the bank partner loan. Some of the cons that we started evaluating is the cost. Is there a cost investment in each loan buying down that interest rate from 5%, right? So we're investing basically 5% of OCAT's funds to support that interest buy down. The bank is not necessarily, I mean, they don't discourage it, but they certainly aren't thrilled when we do a low dollar loan, particularly when you're looking at closing fees and associated costs of those loans. And then another con is that we don't have a lot of control over the fees that the bank charges, closing fees, credit report fees, things like that. So we really kind of started evaluating, are we putting our money in the best place? And then that led to, prior to 2008, interest on monies invested. We're supporting and covering monthly expenses on those interest buy downs and other operating expenses. But from 2008 to about 2015, we were truly budgeting a loss every year due to the lack of revenue. And only managing from invested funds. So we had our original 1.7 that we've got holding over into the bank. We were earning interest off of that, and that was supporting the cost of those interest buy downs and managing the program. So then in about 2014, the board reviewed and revised the sustainability plan for the organization and determined some changes definitely needed to be made. So that's when we started considering direct lending and looking at ways that we can seek additional funding. AbleTech supports with staff. DRS provides some supporting funds through contractual relationships. But for growth, we needed a more strategic plan. So we started looking at some other funding opportunities and looking at that direct lending model. So then it's kind of fun to reflect and tell this story over the years. It brought back some fresh memories of mine. So what were the first steps? Seriously, I'm sitting here going, I have no idea where to start, but I do know this. In order to stay within our lending policy, the board needs to process in a similar way, right? To make an informed decision on their loan. So they need to review a credit report. They need to collect demographics. We needed monthly income and expenses so we could evaluate that debt to income ratio and the ability to make the monthly payment. So basically we need a method to be able to collect all of that same information that the bank was providing for us. So we're like, okay, where do we start? So we just started digging and looking for outside resources. Direct lending criteria questions that we needed to ask were, how can we manage the loan? What software or program is needed to calculate interest, monthly payments, tracking, etc.? What type of state license is needed? In Oklahoma, we learned it's a consumer lending license and really easy to obtain. Report activity on loans. How are we going to report to hold the consumers accountable and give them credit for the payments that they were making? So you have to be a lender to have access to credit reporting agencies, the credit bureaus. We learned that 3 active loans on the books makes you a lender. So that was in the very beginning, okay, we just have to get 3 loans in the books, and then we can start implementing some of these formal processes. By the way, if you have any questions or input, please feel free to interrupt me at any time. I want this to be casual and interactive, so if you do have any questions, please raise your hand or holler at me. So the 3 changes the 3 things that we were looking at, how do we manage the loans, the state license, reporting that activity, ended up bringing in 3 outside agencies and contracts into the picture. We reached out to Credit Builders Alliance. It's an organization that allows nonprofit organizations to pull credit reports for financial education and loan decisions, provides training and resources for financial education and credit lending and credit reporting. They provided one-on-one assistance to get our nonprofit geared up for financial lending and financial education. Then we looked at down-home solutions. I know there's a lot of different softwares out there, and there's a lot of varying opinions on each of those softwares. But we are using down-home solutions, software utilized to manage the loan that allows loan type tracking, creating the amortization schedule. It interfaces with Metro 2 files that get sent to the credit reporting agencies. It will also interface with our accounting software, which happens to be QuickBooks. And then we needed an outside agency, one of the three credit bureau agencies, to be able to pull credit reports and then report loan activity. Pulling credit reports is important to our board and within our board policy to make that informed decision. So those are the three outside agencies and contracts that we were considering and went with. In regards to the three credit agencies, TransUnion, Equifax, and Experian, we ended up going with TransUnion based on, when you have a relationship like most of us do with a state agency housed at the university doing contractual work for the nonprofit organization, TransUnion was able to see and understand that relationship and work with us on that. But if you're going to be using a credit bureau to report loan activity or to pull credit reports to make an informed decision on the loan request, it will require a lengthy application, an agreement, and it requires an on-site visit by that agency. They have to know that you're a legal entity. These are the main criteria right here on the screen that they look at. A legal entity, a lease agreement, or whatever type of documentation you can show that shows that this is a permanent residence for your organization, a permanent sign showing that it's not just a fly-by-night payday lender. They look at your network security, documentation security, and appropriate documentation storage and destruction, and then computer security as well. So once you do that, then they give you the go-ahead to start using their organization, their website to pull credit reports and then report that activity. I think it's important to look at the startup cost. Obviously, that's usually a big barrier. This was several years ago when we started the direct lending process, but the state license was $120, and of course that's going to vary by state. CBA membership at that time was $1,150 to start up, plus annual dues. I'm not sure if it's the same now, but I would think it wouldn't be too much of a variance. TransUnion startup was $150, and then we pay per negotiated rate with CBA for each credit report that we pull. Down-home solutions software initially purchase was $3,070. Now we utilize their cloud version with monthly access rather than annual dues. And that's about $1,400 a month if you break it down per month, depending on the add-on services that you request. You can do QuickBook interface, ACH account draft interface, CDFI, the number of users that you have. That's going to vary the pricing, but that kind of gives you a good ballpark of where we started at for that. So now we're all set up and ready to go, but we are still a little conservative and a little weary of where we're going, and we want to make sure that we're making an informed, incremental decision, right? So baby steps was our methodology through all of this. Year one, we put the criteria for any direct loan. We would do direct loans for anything under $1,500. And the policy criteria was that it was the same approval process as a guaranteed loan, which meant a credit score of 500, income to debt ratio of 50% or less, showing the ability to make the monthly payment, and no negligent debt outside of medical or anything like that. So it's kind of the same criteria. It gave our board confidence that they weren't taking any greater of a risk than what they were with a guarantee loan. But we did limit that because it was such a small loan amount at $1,500. We limited that to a repayment term of 12 months. So our first year of loan data was 2 loans. Woohoo! We were dancing. 2 loans, a total loan value of $1,668. So then year 2, we thought, okay, we did this, we're good. Year 2 was another increment of loans. We increased the loan amount to $2,500, lending repayment terms of 12 to 36 months. Some of the hiccups and outcomes that we ran into was we had dual data systems. We had our Access database that was doing our loan federal reporting outcomes, and then we had our down-home solutions for loan management. We also implemented TransUnion Open Access, and that's a program through TransUnion that gives you permission to share that credit score and the reason codes with the consumers for additional financial education. So that was just kind of a little add-on that we were able to do. In the second year, we did a total of 6 loans for $6,180. So that was, I mean, even though 6 loans is not much, that's a big jump from 2. So we felt pretty good about that and felt confident to go on to year 3, increasing the loan amount to $4,000, lending repayment terms 12 to 36 months. We did implement an additional criteria through board policy. When we entered, okay, let me back up. When we increased our loan amount to $4,000, we started seeing applications that would have normally been a non-guarantee loan with the bank in our old model, right? So we were seeing credit scores of people that had really excellent credit. They had no adverse items on the credit report. They had great debt to income ratio. So we implemented kind of a fast track approval policy with our board. So we weren't having to wait 5 days to get those no-brainer loans approved. So we did an expedite exceptional applications with the criteria you see on the screen there, where we could actually approve via email and then affirm that in the next board meeting. That definitely helped with some of our loans and some of our vendors that we were working with to help get the ball rolling a little bit faster. That year, we did 13 loans for $20,000, total of $20,865. So we got through 3 years of direct lending doing baby step growth. And so then the board was like, okay, what are the next steps? We started looking at CDFI. It's this beast that everybody's been talking about, right? And I promised Marty I wouldn't go into great detail on CDFI, but since it's part of our story, I do feel like I need to talk a little bit about it and how we implemented it into our direct lending program. But if you know or don't know, Community Development Financial Institution certification is a designation given by the CDFI Fund to specialized organizations that provide financial services in low-income communities and to people who lack access to financing. Provides federal funds to the U.S. Department of Treasury. We decided that we wanted to look at going that route. And so this is some of the requirements to be CDFI certified. I am by no means the expert on CDFI, but these are the basic requirements that you are given to become CDFI certified. Be a legal entity, have a primary mission of promoting community development, be a financing entity, primarily serve one or more target markets by designating at least 60% of your financing activity to one or more low and moderate income or underserved populations. And their underserved populations have very specific parameters: African American, Hispanic, Native American, Alaska Natives, or other. And then you have to define and support what that other would be. provides development services in conjunction with its financing activities, so that financial education component, maintains accountability to its defined market. That is where the board comes in. If you are going for people with disabilities, does your board represent people with disabilities? Or if you're going for low income target market, does your board represent that population or serve that population? And then, of course, you have to be a non-government entity, which explains why OCAT, the nonprofit organization, would be the one doing this. How do we get there? CDFI, we applied for a CDFI technical assistance grant for $125,000, provides funds to support an organization to become CDFI certified. We did some prep work for that, attending some training sessions. We hired a consultant. And the consultant was pretty, costly, $7,500. We brought in our CPA who does our annual audits to help with some of the financial information, since we are experts with people with disabilities, not so much with banking and CPA work. We spent about 120 hours in preparing and submitting this application. And we also consulted with some of our peers across the nation. Washington State, Georgia provided some excellent program guidelines for that. Our original goals that we set for CDFI to help us grow our direct loan program were to hire an employee with banking experience, develop an accessible financial education component, provide some staff training for CDFI certification, develop a capitalization plan, some additional consulting work, and project some conservative growth in that plan. The conservative projected growth was planned to grow from 6 loans in 2016 to 24 by 2020. And I can't wait to show you all these numbers in a minute where we're actually at. We chose to use CDFI funds to accomplish this supporting system. If you don't have the capital, I think you'll want to consider some type of funding to support this growth and change. It doesn't have to be CDFI. It could be some ACL grants, which we're going to talk about in a couple of slides. This is just kind of some more little tidbits about what we have learned with CDFI. A consultant for the CDFI TA application expense versus the expertise and guidance was just kind of a no-brainer. It was costly, but we couldn't have done it without that consulting group. Provided working document. They had a working Google Drive document that really helped drive us and guide us to getting the right language and getting everything prepared for getting it into the CDFI application system. For our TA grant, our target population ended up being low income. There's been a lot of national talk on low income or other, naming specifically people with disabilities as a target population. We've learned over the past year that CDFI is not qualifying any applications under that other people with disabilities and a couple of other classifications, because they are in the middle of some national strategic research to have a better definition of those. So our TA application was low income, and then our future certification application is going to be low income, particularly with a subcategory people with disabilities that we focus on. We made small intentional strides, and I think that is what has driven the success to the implementation. It did require frequent policy change, but allowed time to work through those changes with minimal impact to the workload. We could have, hindsight, realized that we could have put in some of those startup costs into our CDFI TA grant. So when I mentioned a couple of minutes ago that having some kind of supporting funds to do this, whether it's CDFI or ACL grant funds or another source of funds, that can help cover some of that startup cost. So here is our grant projected versus actual direct loan growth. And these are the goals that we put up that we implemented in our CDFI-TA grant, right? So we'll just kind of read across here. Fiscal year 2017, projected goal was 12 loans at a value of $22,000. We actually did 12 loans at a value of $8,873. So not bad, pretty on target. Fiscal year 2018, we did 15 loans. The goal was to do 15 loans valued at $30,000. We did 20 valued at $56,000. So then our fiscal year 19 goal was to do 19 loans at $57,000. And actual to date, and I promise it's not a typo, we've done 179 loans valued at $749,000. Big jump, which leads me to the heading of the next slide. Whoa, did you see that number? What happened? So we had some significant additions to this big picture in fiscal year of 19. First, we were awarded an ACL grant in August of 2018 to expand our low interest revolving loan fund, our direct loan, by providing $552,000 in grant funds, allowing an additional $408,000 for loan disbursements, and $144,000 in training, salaries, marketing, and financial education activities. This allowed us to be more aggressive in our direct loan goals. We modified, because of this grant, we modified our model in 2018 to actually do direct loans of an unlimited loan amount, unsecured. And then we still maintained our guarantee loans with the bank on some of those high dollars secured by liens or other kind of securities, modified vehicles, for example. We still did those with our banking partner because they just provide a wealth of knowledge and resources that we felt like we couldn't replace that with. And then another big thing that affected to this 179 loans to date was we connected with 2 statewide vendors that really thrived and bought into our mission, the value and the shared mission of helping individuals. They really believe in what we are doing and that it's good for their consumers. Their connection sent us in an upward direction that we weren't probably prepared for. So of those 179 loans to date, gosh, probably 90% of those came from 2 particular vending sources that have hearing aid clinics, that have clinics all across the state. It provided some cool connections to be able to reach some of those communities in rural Oklahoma that we would not have been able to reach before. But it did bring a volume of loans that we weren't quite sure we were prepared to handle. So that brings me to a really important point if you're considering direct lending. We found ourselves with too rapid of growth as a result of those connections and that activity. So we, meaning all partners involved, didn't feel like we could sustain the capital capacity to support the volume of loans that we were doing. That $700 and something thousand of loan disbursement that we did over the last few months. Growing from 20 to 179 was a pretty giant leap to us. So we actually took a step back. We re-implemented a maximum of direct loans to maximize our supporting capital. We started utilizing our banking partner again for guarantee and non-guarantee loans over $3,000. We put a $3,000 cap on it. And that probably won't stay forever, but just until we can kind of get caught up financially. We still manage the loan program with 1.5 positions plus some in-kind data entry with our grad students through Able Tech, and they work approximately 20 hours a week. We are currently applying for CDFI, FA, and disability funds to support the loan and program growth. So the moral of the story is it's important to have balance, understand your capacity for growth, and readjust your target line as needed so you can stay conscious and successful in your decisions. So quick little wrap up of where we are now. Our grant updates, we're on track to meet our ACL goals, which closes out this fall. We're on track to meet our CDFI technical assistance goals, which close out in 2020, and we are in the process of doing our CDFI certification, and our CDFI grant application is in the works. Staff shifts in the middle of all of this. I've transitioned from loan coordinator to program manager, shifting from full-time on this project to 0.5 focus on this project. And Natalie has shifted from being our CDFI developer at a 0.75 employee to a full-time loan manager position. And then we're still managing the 1.5 FTE plus student data of 20 hours a week, which is in kind through Able Tech. I feel like that was kind of a rush, although I've talked for a good 40 minutes, but any questions?
Hello, this is Muriel from Connecticut. I do have a question. We're working with a partner bank, and presently the applications, I scan the applications, I look at them, I send out the paperwork to the bank, and they make the decision whether or not to go ahead and use their funds. With the partner bank, they use their funds originally. Now, if they should deny the loan, this is where we're running into problems. We recently had a denial of a loan, and we have an appeal process, something like your second process. Once it's denied by the partner bank, it goes to you for your criteria, and you make a decision there. We have our board that I send the base information. This is what they're looking for. This is why they need it. This is, their debt to income and all that. Give them all that information, and they decide whether or not to approve the loan using our funds. Now, our funds are in accounts, CD and a checking account with our partner bank. And at this point in time, we're having problems with them doing the paperwork because we have no means of doing the loan paperwork. So fortunately for us, they actually reversed their decision and ended up granting this person their loan. But we need to kind of put something in place for us to be able to process a revolving loan out of our finances. Mm-hmm. So we've been going back and forth with this, and at this point, the bank is saying they can't do the paperwork because their name is on the computer-generated paperwork. So what are your suggestions for us to try to move forward here and get this going? I don't, in case because I know we are going to come up with revolving loans again.
Right. That's a pickle. I was sitting here pulling out our contracts to see if I could find the exact language with our contract with our banking partner.
Right.
But the way we have it structured is our nonprofit, OCAT, our nonprofit organization, is listed as a borrower, basically a co-signer, for lack of a better word, on that loan. And part of our language is that if the consumer, on guarantee loans, if the consumer does not make the monthly payment, OCAT will. And then we will continue to make that monthly payment. We give the consumer 3 rescue payments. But in the end, if the loan goes into default because the consumer is no longer paying, we pay that loan off in full for the remainder of the balance. And maybe having some language like that in your banking contract could help with that. I don't know, but go ahead.
Yes, I do believe that probably could, because right now the language is, if it goes into default, they will start the procedure of collections, but it doesn't give us the opportunity to make the payment. It just says that we're responsible, say, for 25% or 50% if they aren't making their payments,
Uh-huh.
and that the loan goes in default. So maybe that is something that we could change within the language of the contract to say that we will
Right.
pay the full amount if they should default.
Right. And so basically the terminology that our banking, we have a banker on our nonprofit board, and with his advisement, which we made the language to be, we are buying that debt from the bank by paying off the loan. And then because we have bought that debt from the bank, we then send the consumer to collections or other means that we can to pay off that, to try to collect on that bad debt.
Okay, yeah, that gives us a lot to look at and see if we can handle it that way, because we do have a way of collecting. So
yeah, well, and I don't remember if we have shared it in the past, but I'd be more than happy. We've always had an open book to any of our documents, and if you'd like a copy of our contract that we have with our banking partner, I'd be happy to share it.
that would be great. Because unfortunately, my supervisor had another meeting today because she was going to be on the call as well, because it's just her and I that handle the program. So,
all right. Yeah, I'll get a copy of that to you. I might ask for Marty to remind me to get us connected so I can get that to you.
I believe he sent out an email that you had responded to earlier in the week, and so I have your contact information, and I'll just shoot you an email next week.
Perfect.
Thank you.
You're welcome.
Any other suggestions on how we can handle revolving loans?
Does anybody else out there?
Okay, well, I thank you for all the information. It's been great.
Good. Marty, I'll turn it over to you.
Good, that sounds good. And there were a couple people that did get on late, so we will have the recording available, and we'll send out that information, that link, once it gets posted. And so if you are pursuing a direct lending program and have questions after the call, please feel free to contact us, because I know Shelley will be happy to answer any questions about anything that she's presented. The other thing, if there's no other questions that I wanted to mention, is we'll be also having a webinar on Thursday, June 20th on the ABLE Act, of course, the Achieving a Better Life Experience from 2014, and there's a lot that's happened with the ABLE Act just over the years since it's been created. There's been legislation introduced to improve it. Mark Reichert of the ABLE National Resource Center will be on the webinar to talk about the ABLE Act savings programs, where they're at in 2019. And there's over 40 states now that have implemented ABLE programs. And so it certainly is a complementary program in terms of what we're trying to do with providing either finance or some resources for assistive technology. So if there aren't other questions, then I want to thank you again, Shelley, and to everybody that was able to join us. And like I said, if you have any questions to follow up, then please feel free to do that. And otherwise, I want to wish everybody a great afternoon. And thanks a lot.
And have a great holiday weekend, everyone.
Yeah. Thank you all very much. I appreciate the opportunity. Any way I can help somebody's journey be easier, I'm happy to share.
Well, thank you. Bye-bye.
Bye.